Valens Research, Uniform Financial Analytics.
And so for Abbott, what's so important that we first see here is what we call the PVP, Performance and Valuation Prime Chart. And what I'm going to do is I'm just going to go size with this so we can see everything. And so with Abbott, what we're seeing here is first, what is the performance of the company, and then what is the valuation of the company. The first page that we always come to when we look at a company here in the Uniform Accounting Framework of Valens Research is the PVP chart, or Performance and Valuation Prime Chart, right? The name says what we're looking at here. And so we're looking at first and foremost our ROAs, return on assets. What is the real return of this business? You can see there are orange bars and there are blue bars. The orange bars are the distorted as reported ROA, return on assets returns of this company of Abbott. If you look at Abbott and you look at the as reported returns, you would see a company that used to actually have 10% returns before 2009, 2010. Then returns fell materially in 2011, 2012. Things came off patents, they had issues. And then since then, right after they divested AbbVie, et cetera, returns have recovered some, but have never recovered to the levels that they were back in 2004, 2010. And quite frankly, even then, they weren't that profitable. In reality, when we look at the blue bars, the true blue uniform accounting data for this company shows us what the real performance of Abbott has been. But when we look at this, Abbott actually isn't at lower ROAs than they were back in 2008 to 2010. They're actually approaching all-time high ROAs once we remove the noise, right? What is that noise that we're removing? It's a great question. One of the tabs that we give you access to on the Valens Research app, Uniform Accounting, is what we call the Impact of Adjustments tab. What this tab shows you is what are the material adjustments that we're making under uniform accounting to get us to what the real performance of this company is. For Abbott, there's a couple key ones on both the earnings side and the asset side, right? And our return on assets is earnings over assets. We just do look at adjusted earnings and adjusted assets. For the earnings side, right, you can see because of Abbott's amortization expense, right, related to acquisitions that are not related to the operations of the business, but just related to a truing up of how you account for acquisitions, because of their interest expense and stock option expense, and because of R&D investment, earnings are understated. Now, you might ask, why would I ever add those numbers back? Those numbers are part of earnings, aren't they? Well, amortization is a non-cash expense. It has nothing to do with the operations of your business on a day-to-day basis. It has to do with the fact that you acquired something else in the past, and you are just basically trying to get rid of that intangible asset that you paid for when you acquired it. It has nothing to do with your investment in operations today. Second, interest expense. Our focus under uniform accounting is understanding what the operating profitability of a business is. Interest expense fundamentally has nothing to do with operations. Interest expense is a financing activity decision. Do you want to finance your growth of your business through equity, through cash on the balance sheet, or through debt? Right? And you're choosing debt. The great example of why it's such a ridiculous statement for any company other than a bank to have interest expense on the income statement as an operating cost. If you pay a dividend, does that show up on your income statement as an operating cost? Does that show up in your statement of cash flows as an operating cash flow? No, it doesn't. It shows up as a financing activity. And yet we include interest expense as an operating activity. That makes no sense, which is why we actually add it, which is why for interest expense, we add it back. Similarly, stock option expense, there are two reasons why it really doesn't make sense for stock option expense to be part of the operating income statement. The first reason is actually obvious when you stop and think about it for a moment. The reason why is because literally stock option expense is a non-cash charge meant to reduce your operating expenses by paying management and turning them into shareholders. You are actually helping reduce your operating costs of the business in a savvy way. It is a non-operating cost. It is a question about how you're financing your activities. But the second, actually more important way and less often discussed reason why stock option expense shouldn't be in the operating income statement is most of that line, most of that $519 million last year that showed up on Abbott's income statement about stock option expense was not actually compensation. It wasn't them paying, it wasn't the management team being paid. It was just the change in value of the assets of the options and other derivatives that management is being compensated for by, I should say, the change in the value of those derivatives from that were already granted to the company, right? So if management over the last 3 years was granted options and Abbott stock price became more volatile, right? Black-Scholes says we need to account for the fact that the value of those options rose. Where do we show that up? On the income statement, which doesn't make any sense. It's not about operations at all. And lastly, R&D CapEx versus R&D expense. What this bar represents here is we're actually showing, hey, what is the net incremental investment the company is making in R&D besides what they would need to make to just continue to do what they're doing now, right? How much are they really aggressively reinvesting in the business for growth relative to what they need to? And so the important thing here is when we think about R&D, it's really interesting that we expense R&D, because most of you, if any of you were ever took an accounting class, you might remember an important rule. There's a rule in accounting, the first rule that you're supposed to learn, called the matching principle. The matching principle says that we need to match the expenses that occur for a business, that a business incurs, over relative to the revenue that's actually recognized that's related to that expense. So if you don't have revenue coming in related to an expense, you don't actually recognize the expense yet. R&D expensing flies in the face of that. But just think about it. If I'm going to be expensing R&D today for an investment that I'm making in the future, I'm literally not matching my revenue and my costs. So what we do is we capitalize R&D and we amortize it over time. So those are some of the big adjustments that we're making on the earnings side. On the asset side, very similar to amortization expense, right? We're taking out goodwill and intangibles. Why? Those don't have to do with the operational investment of the business. Those are related to a prior decision you made to acquire the business. Now, if you're a serial acquirer, a material serial acquirer, maybe we should understand that this is actually part of the investment that management's making. And when we're judging the business, we should judge returns, including this. But for most companies, it just doesn't make sense. Also, like we talked about, we capitalize R&D, so we put that on as an asset on the balance sheet. We net out working capital, which is these factors. And then there are a few other adjustments, but those are the key things. So once we make those adjustments, all of a sudden what's apparent is Abbott is not a poor returning business. Abbott is actually at its highest returns ever, and Abbott's returns are above 20%. But that's not all, because once we look at these dark blue bars, then we can look at these light blue bars and these white bars. The light blue bars here are what the company's performance is forecasted to be by sell-side analysts over the next 2 years. This is trying to understand, based on the sell-side analyst estimates and us taking it and transforming it into uniform accounting, are returns improving? Are returns declining? Right, and what we can see is returns are forecasted right now to improve over the next 2 years. And these 3 white bars are also, they are the most important bars in this analysis. These 3 white bars are what the market is pricing in right now for the company. And what the market is pricing in right now for Abbott at the current stock price for the company, which is obviously now lower than the $80 that it was here when we actually did this, when we last updated the database, but the market is basically pricing returns to be flat. So when we look at Abbott, we need to understand the company has improving returns that are forecasted to continue to improve. The market's pricing them to be basically stable. Okay, that's helpful. Now let's understand the second chart. The second chart is asset growth. Right, and for asset growth, we're looking at here again is these orange bars versus the blue bars. Look at how many times the orange bars and the blue bars are sometimes directionally wrong, like here in 2016 and 2018. As reported metrics would tell you that Abbott's growing when it's actually shrinking, or vice versa. And then we've got these white bars, right? These white bars tell us what is the market pricing in. Over the last 5 years, Abbott's growth has probably been around 5 or 6% a year. The market's pricing it to remain around those levels if you average out over the last 5 years and into the next 5 years. Similarly, Abbott has seen returns stabilize but improve slightly. The market's pricing that to continue. It seems the market actually gets what's going on with Abbott. That is performance. Then we look at valuation. We got VA, value to asset prime ratio, and VE, value to earnings prime ratio. This is about where we're seeing trends in terms of valuation to understand if the market is getting more or less bullish about a company. VA is our adjusted price to book metric. Instead of being price to book equity, it's an enterprise value over our adjusted asset base. There's a very strong relationship between this metric and the returns a company generates. You can even see, right? Returns have risen and then VA has risen, right? And then down here, VE is our value to earnings prime ratio. It's our uniform accounting adjusted PE. Sometimes, like back here in 2012 to 2015, you can see as reported metrics might understate how expensive a business is. Sometimes, like here in 2016, as reported metrics overstate how expensive a business is. But understanding where valuations are and what real returns are for a business and valuations helps us understand whether or not a business is undervalued or overvalued, not just point in time, but relative to history. And this last chart here, this last chart is TSR relative to the market, right? What is TSR? TSR is total shareholder return, the total stock appreciation and bond returns that an investor gets when they own the company's stock for a year. And the R relative to the market is we're actually comparing it to the market's return and saying, hey, did the company for each year outperform or underperform the market? When this line is flat, it's not quite flat here, but if it was, when this line is flat, that means that the company performed in line with the market. When it rises, like it did here, that means that the company outperformed the market. When it falls, like it did here, that means the company underperformed the market. And so what you can see is there tend to be a very good tracking between the uniform accounting data and this TSR for a reason, because the uniform accounting data is better representative of what real fundamentals are, of what the real fundamentals are for the business, and the market knows that, which is why if you're not looking at the uniform accounting numbers, you're getting bad data.
Valens Research, the world's leading source for uniform financial analytics.